Hey guys, tonight we're diving deep into a topic that trips up more people than they'd like to admit. Investing. Now, if you're thinking this is going to be one of those quick and easy money discussions, let me stop you right there. The idea that investing is a get-rich-quick scheme, that's one of the biggest illusions out there. And trust me, if that's how you approach it, you probably won't survive this. Before we get cozy though, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. I want this to be a place where you can learn, not just follow. And hey, don't forget to post your location and local time in the comments. Let's see where everyone's tuning in from tonight. Now, dim the lights. Maybe turn on a fan for that soft background hum. And let's ease into tonight's journey together. When you think about investing, what's the first thing that comes to mind? If you're like most people, you might picture the stock market as a fast-moving train. Some people get on, and before you know it, they're raking in millions. The dream of being the next Warren Buffett, or, dare I say it, the next big thing in Silicon Valley sounds pretty sweet, right? But here's the thing. Most people fail at investing because they chase that fantasy of easy, fast wealth, and when they don't get it, frustration sets in. They pull out, or worse, they lose it all. Let's break this down. Investing, in its purest form, isn't a sprint, it's a marathon. If you think you can simply jump in and walk away with a windfall in a couple of months, you're going to be disappointed. Investing isn't about finding the secret stock that's going to rocket to the moon overnight. It's about understanding the fundamentals, doing your homework, and being patient. In fact, there's a saying that goes, "The stock market is a device for transferring money from the impatient to the patient." Let that sink in for a moment. And yet, here we are, living in a world where impatience is practically a virtue. We've been conditioned by social media, by instant gratification, and by the idea that success should come fast. So, you get people jumping in and out of stocks, making emotional decisions based on hot tips or the fear of missing out. They hop on the latest trend, and before they know it, they're burned out or left with little more than a portfolio full of regret. Why does this happen? Well, the allure of quick returns is powerful. We're all told that if we just find the right company, the right product, the right trend, we'll be set. But the reality is that most successful investors, the ones who actually make their money stick, didn't get there through sheer luck. They didn't get there by betting on the next big thing or trying to time the market. Instead, they built their wealth by investing in things they understood, by staying disciplined, and by exercising patience. Think about it, Warren Buffett. The man himself built his empire by looking at businesses, not stocks. He doesn't focus on the ticker symbol or the daily fluctuations in price. He buys companies he believes in, companies that have strong fundamentals and a sustainable competitive advantage. And then he waits for years, sometimes decades. It's boring, right? It doesn't have the instant gratification that we're conditioned to crave. But that's exactly why it works. Historians still argue whether the rise of day trading and the rise of social media investment groups are beneficial or harmful to the long-term financial health of individuals. But one thing's for sure, these trends reinforce the idea that you can make big money fast. And it's why people fail. They're chasing the wrong goal. Now, let's talk about impulse investing. You've probably seen it happen. Someone hears about a stock that's hot or is going to explode. Maybe it's a friend. Maybe it's a guru on YouTube. Or maybe it's a stock you just spotted on your social media feed. It looks good. It feels good. So you jump in, right? Here's the thing. That's not investing. That's gambling. You think you're being clever? That you've got an edge over everyone else because you're riding the wave of some exciting stock or crypto trend? But in reality, you're setting yourself up for a fall. It's like walking into a casino, looking at the slots, and thinking you're going to beat the house. The odds are stacked against you, and chances are you'll end up walking out with nothing. So, let me give you a tip that seems simple, but many overlook. If you're going to invest, don't do it on impulse. Take your time, look at the fundamentals, and ask yourself, do I understand what I'm putting my money into? Do I believe in this company or product long term? Is there real value here? If you can't answer those questions with confidence, then you might want to reconsider. Take, for instance, the infamous story of the dot-com bubble in the late 90s. Investors jumped into tech stocks, thinking they were going to get rich off the next big thing in the digital revolution. But, as many of you probably know, the bubble burst, and millions of dollars vanished overnight. It's a prime example of people getting caught up in the hype, investing on impulse, and thinking they could ride the wave to riches. But in reality, most of them just got wiped out. To make matters worse, some investors didn't learn from that experience. A few years later, the housing bubble popped in 2008. People, once again, rushed in, thinking they could flip houses or profit from mortgage-backed securities. And, once again, many of them lost everything. The real lesson here: don't get caught up in the illusion. Don't let your emotions dictate your financial decisions. Because when you're chasing fast money, you're walking right into a trap. Remember what I said earlier. This isn't about betting on the next big thing. It's about slow, steady growth. If you can stay patient and disciplined, then you'll have the last laugh. It's a marathon, not a sprint. By now, you're probably realizing that patience is a big part of the investing game. But let's take this a step further, because it's not just about waiting. It's about understanding the psychology behind why most people fail when it comes to investing. It's easy to get excited about the idea of making money in the market. But the reality is that the emotional roller coaster of fear and greed will often dictate your decisions if you let it. And that's where most investors slip up. We've all heard the phrase buy low, sell high. Sounds simple enough, right? But in reality, most people end up doing the opposite. They buy when things are skyrocketing, and then panic when things take a downturn. That's the power of fear and greed at work. So let's break this down. Fear, for example, kicks in when the market takes a nosedive. You see your portfolio value dropping, and suddenly, you're thinking, I need to get out now before it gets worse. It's that instinct to protect what you have. But here's the kicker: when you panic and sell during a market downturn, you're locking in your losses. You're cementing the damage. And when the market inevitably rebounds, which it always does, you're left watching from the sidelines, wishing you'd stayed in the game. But fear isn't the only emotion that drives bad investment decisions. Greed plays an equally big role. When the market is hot, everyone feels the FOMO, fear of missing out. You watch your friends or people on social media raving about how much money they're making on their investments. And suddenly, you want in. You start chasing after the latest hot stock, ignoring the fundamentals, because you want to make quick gains. You end up overpaying for something that's already inflated in price. And the result? You're stuck holding on to an asset that's lost its value, all because you let greed take the wheel. Historians still argue whether emotional investing is a new phenomenon or just a more visible part of the digital age. One thing's for sure, though: the psychological traps that come with fear and greed are nothing new. Investors have been tripped up by these emotions for as long as there's been a stock market. But in today's world, with endless news updates, social media posts, and constant market noise, it's easier than ever to let emotions hijack your decision-making process. Take a look at the 2008 financial crisis. The housing market bubble was driven by greed, people buying homes they couldn't afford, assuming prices would keep rising forever. They believed that they were making smart investments, that they were somehow immune to the risks of the market. But when things turned, the fear set in. People panicked and began selling off everything they could, driving prices even lower. The result? Massive losses for millions of people. Now, I want to tell you something important about these emotional traps. You can avoid them, but it's going to take some discipline. First, recognize that emotions are natural. Everyone experiences them. But the key is not letting them drive your investment decisions. Instead, focus on the facts and fundamentals. Ask yourself, am I buying this because I believe in the company, or am I chasing a short-term gain? To help keep your emotions in check, it's important to have a strategy in place, and that strategy should include sticking to your plan. No matter what the market is doing, if your goal is to invest for the long term, then stick with it, even when things get rocky. The best investors aren't the ones who jump in and out of the market. They're the ones who can stay calm during the storm and keep their eyes on the prize. And this isn't just theoretical. This is how real-world investors like Warren Buffett made their fortune. Buffett's approach is centered on buying great companies at a fair price and holding them for the long haul. He isn't swayed by market fluctuations or by the latest trends. His approach is rooted in the idea that, over time, Good companies will continue to grow and create value for their shareholders. But let me be clear, Buffett didn't get there by chasing after the next hot stock or selling in a panic when things got tough. He stuck to his principles and remained calm during the inevitable ups and downs of the market. And that's why he's considered one of the greatest investors of all time. So, if you want to avoid the same mistakes that most people make, you have to start by recognizing the emotional traps at play. You can't let fear or greed drive your decisions. Instead, focus on the long-term fundamentals and let your investments ride out the storms. Another critical aspect of avoiding these emotional pitfalls is understanding the market cycles. Yes, the market goes up, and yes, the market goes down. It's natural, but it's those who can weather the downtimes without selling in a panic who come out ahead in the long run. Remember, when everyone is selling, that's often when the best buying opportunities appear. And here's the thing that might surprise you. This isn't just for the stock market. This applies to all kinds of investments, from real estate to cryptocurrencies. If you're emotionally tied to the idea of instant riches, then you're more likely to make irrational decisions based on short-term gains. But if you can step back, take a breath, and focus on the long-term picture, you'll be far better off. So, what can you do to avoid this emotional trap? Simple. Stick to your strategy. Stay disciplined. And remember, the market isn't a race, it's a journey. All right, now that we've covered the psychological side of investing, fear, greed, and all that jazz, let's dive into another big mistake that most people make, thinking they can predict the market. Yes, the old "I'll time it perfectly" approach. You might think you can pick the perfect moment to jump in or out of the market. But here's the hard truth. Nobody can consistently predict the market. Now, some folks like to talk about the expert strategies they've come up with to outsmart the system. They'll point to their analysis, their insider knowledge, or their gut feeling about when a stock is about to skyrocket. But here's the deal, if it were that easy, everyone would be doing it, and you wouldn't hear stories about billion-dollar hedge funds going under. The first thing you need to understand is this. The stock market is influenced by a million different factors: geopolitics, the economy, interest rates, corporate earnings, investor sentiment, and even the weather, yes? Really, there's no way to predict all of these variables with any certainty. Even the so-called experts get it wrong more often than they'd like to admit. But let's step back for a second. Where did this idea that we can predict the market even come from? Well, historically, humans have always sought to predict the future. It's in our nature. We look for patterns, trends, and signs that can give us an edge. It's the same reason why people read their horoscopes or follow weather forecasts with religious devotion. Here's the catch. The stock market isn't a crystal ball. Trying to predict market movements is about as accurate as predicting the weather a year in advance. Sure, you might get lucky a few times, but over the long haul, you'll end up making decisions that are more about guesswork than sound strategy. Historians still debate whether market predictions should be based on long-term trends or short-term analysis. You'll hear some argue that focusing on short-term predictions is an exercise in futility, while others believe that minor fluctuations offer clues. But the reality is, if you rely on predictions to guide your investment strategy, you're almost certainly setting yourself up for failure. Take the example of those who tried to predict the dot-com boom in the late 90s. Many thought they had a handle on what companies would come out on top in the tech industry. But then the bubble burst. Those who had been predicting huge gains ended up with massive losses. The same thing happened with the housing market crash of 2008. Plenty of experts were predicting that the housing market was bulletproof, only for the whole thing to come crashing down. So, what's the solution here? Stop trying to predict the market. Instead, focus on long-term strategies that are built on solid fundamentals. The truth is, you can't control the market, but you can control what you invest in. The best investors, like Warren Buffett, don't try to predict what's going to happen tomorrow. Instead, they focus on investing in strong companies with long-term growth potential and solid business models. Here's a little secret. Buffett has said time and time again that he doesn't try to time the market. He buys companies he believes in, holds them for the long term, and waits for them to grow. He's not sweating the daily fluctuations or trying to predict the next big shift in the market. He trusts that over time, The companies he's invested in will rise in value, and so will his portfolio. To drive this point home, let's talk about a little concept called market cycles. The stock market goes through cycles of boom and bust periods of rapid growth, followed by inevitable corrections. It's the nature of the beast, and the biggest mistake you can make is to try and time those cycles. Think about it every time the market dips. The media and social platforms are filled with people telling you to panic, to sell everything, to avoid getting burned. But guess what? The people who panic and sell end up buying back in at a higher price when the market rebounds, missing out on all the gains in the process. Now, I know you might be thinking, but how can I just sit back and wait when there's so much uncertainty? It's a fair question. Uncertainty is part of investing, and it's always going to be there. But if you focus on companies with strong fundamentals and long-term prospects, you won't need to worry about short-term volatility. You'll have a strategy that can weather the storms. Think about the long-term gains from companies like Coca-Cola, Apple, or McDonald's. These are companies that have survived multiple market cycles, recessions, and shifts in consumer behavior, and yet they've continued to grow over time, creating immense value for their shareholders. They weren't built on short-term predictions. They were built on solid business models that weathered the ups and downs of the market. Here's the bottom line. The market will always be unpredictable, and trying to predict it is a recipe for frustration and failure. Instead, focus on finding quality investments that have the potential to grow over the long term. And when things inevitably dip or fluctuate, don't panic. Just remember that the market has a way of bouncing back, and the most successful investors are the ones who can stay calm and stay in the game. Now, I'm not saying that you should ignore market news or not pay attention to what's going on in the world. It's important to stay informed. But rather than trying to predict the next big move, focus on building a portfolio that will stand the test of time, and let the market do its thing. Remember, slow and steady wins the race. Now that we've debunked the idea of timing the market, let's tackle another major pitfall: the belief that you can beat the market by jumping in and out of investments at the right moments. This idea of being able to predict when to buy and when to sell is intoxicating. But here's the thing, it doesn't work. At least, not in the way most people think. This whole market timing game sounds great in theory. You hear stories about traders who make a fortune buying and selling at just the right time. And maybe you've even tried it yourself. You buy when a stock dips, sell when it spikes, and hope to make a quick buck along the way. But, like trying to predict the weather, market timing is notoriously unreliable. And the reality is, even the best investors in the world, like Warren Buffett, aren't interested in playing this game. Instead, they understand that the key to real success is something much simpler: patience. Take a step back with me for a second. The stock market isn't some mystical entity that rewards those who can make precise predictions. No! It's a system that reflects the collective actions of millions of people making decisions based on their own needs, fears, and desires. It's a giant web of decisions, each influencing the next. But you can't control that. You can't control how someone else might react to news, or how a company might perform in the future. So, why bother trying? Let me put it this way. The stock market, in many ways, is like a wild beast. It roars, it charges, it calms down, and then it charges again. And sure, there are times when you might catch a glimpse of a pattern or trend, but that doesn't mean you're in control. And if you try to make decisions based on what you think is going to happen next, you're essentially gambling. Sure, you might win a few bets, but over time, the house always wins. But here's a little twist. While most people think about market timing in the context of stocks, it also applies to other forms of investing: real estate, crypto, even commodities. Everyone's trying to find that perfect moment when the price is low and the market is ripe for a jump. But guess what? Even seasoned pros know they can't predict the exact moment to strike. It's about playing the long game, not trying to outsmart the system in the short term. Think about it. In 2008, during the financial crisis, the entire world was in panic mode. The stock market was crashing, and people were running for the hills. But if you had stuck with your investments, rather than selling out in a panic, you would have seen the market recover, and those who stayed in the game, buying when everything was cheap, ended up making a lot of money. It's the same thing with the tech bubble of the late 90s. People were making fortunes, and some thought they could time their exit, When the bubble burst, those who had gotten in early and sold at the peak did well. But those who held out too long, they were left with losses. And some even had to shut down their businesses. The key here is that it's not about predicting when the market will drop or rise. It's about being in it for the long haul and holding your investments through the ups and downs. Now, I know what you're thinking. Okay, Warren, but how can I make sure I'm not just buying a stock because it's on the rise and going to crash later? That's a fair question, and here's the answer. You need to buy into companies that have a strong foundation. This is where value investing comes in, instead of buying a stock just because it's cheap or on sale. Look at the company behind the stock. What's its business model? Does it have a competitive advantage? Is it making a profit? Does it have a sustainable plan for growth? And I know what you might be thinking here too. This sounds like it takes too much work. But it's actually quite simple. When you focus on companies with solid fundamentals, you don't have to worry so much about market timing. These are the businesses that will continue to grow over time. Regardless of whether the market is up or down, the value of your investments will appreciate in the long run, even if the market dips for a while. Take, for example, a company like Apple. When it first went public, people were skeptical. It was a niche product. And who knew if it would last? But Apple's founders believed in their products, and they focused on building a great company, not just jumping on the latest trends. Over time, Apple's stock appreciated significantly because it was a company that produced solid products with loyal customers. And while there have been ups and downs in its stock price, the company's value kept growing, and those who held on for the ride were rewarded. The mistake that most people make is thinking they can time their way into or out of stocks like they're playing the lottery. They look at the stock price, see it's low, and think, now's the time to buy. Or they see a stock soaring and think, I need to get in before it goes any higher. But what they often don't realize is that the stock's true value is much more important than its daily price movement. Now, I'm not saying that you should ignore the market altogether. Of course, you need to keep an eye on your investments. But the point is, trying to predict the next big rise or fall is a fool's errand. Instead, focus on building a diversified portfolio of companies with solid fundamentals. And stick with them. The market will do its thing, and your investments will grow in time. The simple truth is this: you can't control the market, but you can control your decisions. And by focusing on companies with long-term potential, you'll avoid the trap of trying to time the market. Stay patient, stay disciplined, and let the investments work for you. Let's slow things down for a bit and dig into something that's crucial for long-term investment success: the power of compounding. This is one of the most important concepts in investing, but somehow it's often overlooked by those who want to see instant results. And that's a huge mistake. You've probably heard the term compounding tossed around, but let's break it down. Compounding is the process where the money you make on an investment starts making money itself. Think of it like a snowball rolling down a hill. It picks up more snow the longer it goes, and it becomes bigger and bigger over time. The longer you let your investments sit, the more your returns start working for you. That's how wealth is built slowly, steadily, and consistently. The best part, compounding doesn't require you to do anything. Once you've invested, you just sit back, relax, and let your money grow. You don't need to be constantly tweaking your portfolio or jumping in and out of stocks. The real magic happens when you give your investments the time they need to grow. Now, I know some of you might be thinking, all right, that's all fine and dandy, but I want to see results now. Why wait 20 years to see big returns? I get it. We all want that instant gratification. But here's the catch: if you start early and let your investments compound over time, your returns can actually be exponential. It's not about making a huge gain overnight. It's about making small, consistent gains that build on themselves over time. Let's consider an example. Imagine you invest $1 in the stock market, and you get an average annual return of 7%. That doesn't sound like much at first, but here's where compounding comes into play. After 10 years, that $1.000 would grow to about $1.967. Not bad, right? But the real magic happens in the next decade. After 20 years, your original $1.000 investment would have grown to over $3.869. That's a 286% return on your initial investment, just because you gave it time to compound. And if you let that money sit for 30 years, you'd be looking at over $600, all from a $1 or investment. Now, I'm sure you can see where I'm going with this. The longer you leave your money to grow, the more it multiplies. That's the beauty of compounding, and it's why patience is so important when it comes to investing. Sure, you can make quick gains in the short term, but those who truly build wealth are the ones who understand the power of compounding and give their investments the time they need to grow. But here's the kicker: compounding works best when you're consistent. Let's say you're able to invest $500 each month, starting with $0. If you stick to that plan for 30 years and earn an average return of 7% per year, you'll have over $700. Zero by the time you retire. You don't need to be a genius, and you don't need to time the market perfectly. All you need is consistency and time. You might be wondering, what's the catch? Well, the catch is that most people don't stick with it. They get impatient. They pull their money out when the market dips, or they get distracted by the next big investment trend. But those who succeed are the ones who can ignore the noise. Stay consistent and let the power of compounding do its work. Let's take a moment to talk about the famous investor, Warren Buffett, and his relationship with compounding. Buffett himself has said that the most important factor in his wealth-building strategy is his ability to let his investments compound over time. He's not interested in quick wins or short-term gains. Instead, he focuses on buying businesses that he believes will continue to grow over the long term. He doesn't mind the ups and downs of the market because he knows that, over time, his investments will continue to grow and compound. Buffett's favorite investment is Berkshire Hathaway, and he's been buying shares of it for decades. Over time, the company has grown significantly, and the value of its stock has compounded at an impressive rate. But what's more impressive is how Buffett's wealth has grown as a result. He's not someone who's focused on getting rich overnight. He's focused on building lasting wealth through the power of compounding. This isn't just true for individuals. Compounding works for institutions too. Consider the long-term growth of companies like Amazon, Apple, and Coca-Cola. These companies have seen their stock prices rise steadily over time. And the longer you've held on to their shares, the more you've benefited from compounding growth. And it's not just about the stock price. The value of their products, their market share, and their customer base have all compounded, creating a stronger foundation for their businesses. So, how can you use this knowledge to your advantage? Start early, invest consistently, and most importantly, let your investments compound over time. Don't get distracted by the ups and downs of the market. Stick to your strategy, keep adding to your investments, and give them time to grow. And here's another tip. Don't try to pick individual stocks just for the sake of it. Instead, focus on low-cost index funds or exchange-traded funds ETFs that allow you to invest in a broad range of companies. This way, you'll benefit from the overall growth of the market, and your money will have the opportunity to compound in a diversified way. Compounding is one of the most powerful tools in an investor's arsenal, but only if you let it work for you. Don't try to rush the process. The real magic happens over time. And the longer you can stay invested, the more your wealth will grow. Trust the process and let compounding work its wonders. Now that we've covered the basics of patience and compounding, let's shift gears and talk about diversification. Many of you might think that spreading your investments across a bunch of different assets is a sure way to protect yourself from risk. But let me tell you, while diversification is important, it's not a one-size-fits-all solution. Too much diversification can actually hurt you more than it helps. Yes, you heard me right. So, let's break this down. The idea behind diversification is simple. Spread your investments across different stocks, bonds, real estate, and other asset classes so that if one investment goes down, the others will keep you afloat. And on the surface, that makes sense. It's a great way to reduce risk in theory, but here's where things start to go sideways for many investors. They overdo it. Picture this. You've got a portfolio with 50 different stocks, 20 mutual funds, 10 bonds, some real estate, maybe a bit of cryptocurrency for spice, and a handful of index funds. Now, here's the thing. If you spread yourself too thin, you're not giving any one investment the attention it deserves. And worse, you're diluting your potential returns. That's right, by spreading your money too far and wide. You may actually be losing out on the big gains you could have made from focusing on a smaller number of well-chosen assets. Historians still argue whether there is an optimal level of diversification, but the reality is that diversification needs to be done strategically. More isn't always better. It's not about throwing your money into every possible investment vehicle you can find and hoping for the best. It's about being smart with where you place your money and balancing risk and reward in a way that aligns with your goals. Let's take a look at Warren Buffett's own approach to diversification. If you've studied Buffett's investments, you'll know that he isn't a fan of spreading his money too thin. Instead, he focuses on buying great companies that he understands, with strong competitive advantages and the ability to grow over time. Buffett's portfolio isn't packed with dozens or hundreds of different stocks. Rather, it's concentrated on a few high-quality businesses, such as Coca-Cola, American Express, and more recently, Apple. In fact, for much of his career, his most significant investments have been in just a handful of companies. Buffett's method isn't about avoiding risk at all costs. It's about understanding the risk you're taking and making sure it's calculated. He's willing to bet big on a few stocks because he believes in their long-term potential. And that's the key here. You don't need to own every stock under the sun to be a successful investor. You need to own stocks that are going to create lasting value. But, of course, that doesn't mean you should throw diversification out the window entirely. Having some diversity in your portfolio is important, especially if you're just starting out or if you're risk-averse. The trick is finding the right balance. If you put all your money in one company, you're taking on an enormous amount of risk. And if that company fails, your portfolio could take a massive hit. On the flip side, if you have too many investments, you'll likely end up with mediocre returns because none of your assets are making a significant impact on your overall wealth. One way to avoid this pitfall is to focus on what's known as concentrated diversification. This means you concentrate your investments in a smaller number of carefully selected assets, but you still spread your investments across different sectors to reduce exposure to one particular market or industry. For example, you might decide to invest in companies from different sectors: technology, healthcare, consumer goods, but you only choose a handful of stocks in each sector that you believe in. That way, you're not over-diversifying, but you're still protecting yourself from risk by having exposure to different industries. Think about the tech boom of the 1990s. Everyone was diving into the dot-com stocks, and many investors thought the more tech stocks they owned, the safer they would be. But when the bubble burst, those over-diversified portfolios didn't shield anyone from the losses. On the other hand, those who concentrated their investments in well-established tech companies, like Microsoft and Apple, came out ahead in the long run. And then there's the issue of diversification for diversification's sake. People often think that by buying a little bit of everything, they're covered. They grab a handful of index funds, some international stocks, some emerging markets, a couple of bonds, and call it a day. But here's the problem. If you don't know the underlying assets in those funds, then all you're doing is buying a collection of stuff. You're not making educated, strategic choices, and that can lead to mediocre performance. Let's also talk about the role of bonds in diversification. Bonds have long been seen as a safer investment, something that adds stability to a portfolio. But here's a little secret. Not all bonds are created equal. Bonds can carry risk too, especially if interest rates rise or the bond issuer faces financial difficulties. Don't just add bonds for the sake of it. Make sure you understand the type of bonds you're holding and how they fit into your overall investment strategy. When it comes to real estate, it's another area that many people add to their portfolios for diversification. Real estate can be a solid investment, but it's also illiquid, meaning you can't just sell it off easily like stocks. And remember, just because a property market is hot doesn't mean it's a good idea to jump in. Always do your research and understand the market before committing. In the end, it's all about being strategic. Don't just diversify for the sake of it. Look for the best opportunities based on your risk tolerance and long-term goals, and spread your investments across assets that make sense for your portfolio. The right balance of diversification will give you a good mix of stability and growth, without overexposing you to risk or watering down your returns. Remember, you don't need a huge number of assets to achieve long-term success. Focus on quality, not quantity, and let those investments do the heavy lifting over time. All right, let's shift gears a little bit and talk about something that can be a real game changer in your investment journey. Focusing on value over hype. The truth is, the market is full of distractions, hot trends, hyped up stocks, and people claiming to have the next big thing. But here's the cold, hard truth. Chasing after hype is one of the quickest ways to lose money. Now, I know it's tempting. You hear all the buzz about a stock that's making headlines, or you get caught up in the excitement of a new cryptocurrency. Everyone's talking about it. It's all over social media, and it seems like everyone's making a killing. You feel like you're missing out if you don't get in. So, what do? You buy, and that's exactly where most people go wrong. Here's the thing about these hyped-up investments. They're usually driven by emotions, not fundamentals. They're often inflated by a buzz that gets out of control. And before you know it, the stock or asset is overvalued. Once it reaches its peak, it comes crashing down. And those who jumped in on the hype are left holding the bag. Take the infamous case of the dot-com bubble back in the late 90s. People were throwing money at anything with a "come" in its name. There were companies that hadn't even turned a profit yet, but their stock prices were soaring because the hype was so strong. Investors jumped in, thinking they were going to ride the wave of the next big thing. And then, when the bubble burst, the market crashed. Those who had been caught up in the excitement lost everything. Historians still debate whether the dot-com boom was a result of investor greed or a genuine belief in the internet revolution. But one thing's for sure, when the hype dies down, the true value of those investments becomes painfully clear. The stocks that had been trading at inflated prices were suddenly worthless. It's a lesson that we should all take to heart. Hype may make you rich in the short term, but it's a fast ticket to losses in the long run. Now, let's talk about how to avoid falling into the trap of hype. The key here is to focus on value. Value investing is all about buying companies that are undervalued or selling for less than they're worth. You don't care about the hype or what people are saying on social media. Instead, you look at the fundamentals, the company's earnings, its management, its competitive advantages, and its long-term prospects. Warren Buffett is, of course, the master of value investing. He doesn't care about the latest hot trend or the next big thing in tech. Instead, he focuses on companies that have strong fundamentals and long-term growth potential. He looks for companies that are undervalued by the market but have the potential to thrive over time. It's not about the short-term excitement. It's about finding investments that will stand the test of time. For example, take a company like Coca-Cola. It's not the flashiest stock in the world, but it's been around for over a century and has shown incredible resilience. Despite ups and downs in the market, Coca-Cola continues to generate steady profits, and its brand is one of the most recognizable in the world. When Buffett first invested in Coca-Cola, it wasn't because the company was riding some short-term trend. It was because Coca-Cola had solid fundamentals, a strong brand, a global reach, and a track record of success. He saw long-term value in the company, and that's why he made the investment. But let's not just talk about the past. The principles of value investing are just as relevant today. In fact, with the explosion of social media and constant market noise, it's easier than ever to get caught up in hype. Cryptocurrencies, meme stocks, and other speculative assets are constantly making headlines, and while some people might make a quick profit, many others are left holding assets that are overvalued and risky. To avoid the trap of hype, you need to do your homework. Look at the company's financials. Are they profitable? Do they have a competitive advantage? Do they have a long-term strategy for growth? These are the questions you need to ask yourself before investing. It's about looking beyond the headlines and focusing on what truly matters. Let's also talk about another important concept: margin of safety. This is a term you'll often hear Buffett use, and it's crucial to understanding value investing. The margin of safety is essentially a cushion that protects you from the downside risk of an investment. It's the difference between what a company is worth and what you're paying for it. When you buy a stock at a discount to its intrinsic value, you have a margin of safety. This means that even if things don't go as planned, you've built in some protection against potential losses. For example, if a company is worth $100 per share, but you're able to buy it for $70, then you have a $30 margin of safety, even if the company's stock price drops, as long as it's still worth more than what you paid for it. You're protected. This is where the hype can really mess things up. When you buy into the latest trend or get caught up in the excitement of a hot stock, you're often buying at an inflated price, without a margin of safety. And when the hype dies down, you're left holding a stock that's worth much less than what you paid for it. The key takeaway here is simple. Focus on value, not hype. Do your research, buy companies that are undervalued, and make sure there's a margin of safety in place. Don't chase the next big thing. Instead, focus on building a portfolio of solid investments that will stand the test of time. At the end of the day, it's not about catching the latest trend. It's about finding companies that are fundamentally strong and have the potential for long-term growth. And that's where the real money is made over time, with patience, research, and a focus on value. Now, let's talk about one of the most fundamental aspects of investing that seems to be lost on many people: understanding the business behind the stock. Sounds simple enough, right? But surprisingly, too many investors buy stocks without really understanding the companies they're investing in. And that, my friend, is a recipe for disaster. You see, buying a stock isn't just about seeing the ticker symbol on your screen and hoping it goes up. When you buy a stock, you're essentially buying a tiny piece of a business. That means it's crucial to understand the business behind that stock, the products or services it offers, its market position, its management, and its long-term strategy. Now, I know what you might be thinking. I don't have time to become an expert on every company I invest in. Fair enough. But here's the thing. Investing is about more than just picking stocks at random. If you're truly serious about building long-term wealth, you need to make an effort to understand the companies you're investing in. It's not about memorizing every detail, but about understanding the basics that will help you make informed decisions. Let's take Warren Buffett as an example. One of the key principles behind his investment philosophy is something he calls investing within your circle of competence. What does that mean? Essentially, it means investing in businesses that you understand. Buffett has always emphasized that he doesn't invest in companies or industries he doesn't fully comprehend. If he doesn't understand how a business makes money, then he doesn't invest in it. This approach has allowed him to consistently make smart investment choices over the years. Now, I know what you're probably thinking. That sounds great, but how do I even start to understand a company? Well, it's simpler than you might think. Start by looking at the company's financials. This includes their income statement, balance sheet, and cash flow statement. Don't worry, you don't need to be a financial expert to understand these. Just get familiar with the basics. Is the company making money? Is it growing its revenue? Is it generating enough cash flow to sustain its operations? Once you've got a handle on the numbers, take a deeper dive into the company's competitive position. What makes this company different from its competitors? Does it have a strong brand, a unique product or service, a loyal customer base? Is there something about the company that gives it a sustainable, competitive advantage, what Buffett refers to as an economic moat? An economic moat is essentially something that protects the company from competition, allowing it to continue generating profits year after year. Another important aspect of understanding a business is its management. Are the company's leaders experienced and trustworthy? Do they have a clear vision for the future? Good management is often one of the key factors that determines a company's long-term success. And it's something that Buffett places a great deal of emphasis on when evaluating potential investments. He's not just looking at numbers, he's also looking at the people running the business. Now, you might be thinking, but this sounds like a lot of work. And I get it. Researching companies can be time-consuming. But here's the thing. It's worth it. If you understand the business, you're going to make better investment decisions. You're going to be able to spot opportunities that others might miss. And more importantly, you'll be able to avoid potential pitfalls. Because when you understand a company, you can look beyond the daily fluctuations in its stock price and focus on the bigger picture. And let's not forget about the power of dividends. Some of the most successful companies in history have generated wealth for their investors, not just through stock price appreciation, but also through consistent dividend payouts. Dividends are a great way to generate passive income from your investments, and they can also be a sign of a healthy, stable company. So, don't just focus on the price of the stock. Take a look at the dividends, too. But here's where many investors go astray. They get caught up in the price of the stock without considering what's behind it. They'll buy into a company because they think the stock is cheap. Or they'll jump on a stock that's been rising quickly, hoping to catch a quick gain. But if they don't understand the business, they're essentially gambling. You might get lucky once or twice, but over time, your chances of success will decrease. The real value in investing comes from understanding the businesses behind the stocks. And once you've built a portfolio of companies that you truly understand, then you'll be able to make informed decisions. Stick to your strategy and ride out the inevitable ups and downs of the market. Another reason why understanding the business is so important is that it helps you avoid the trap of chasing short-term gains. When you buy into a company because you believe in its long-term prospects, you're less likely to be swayed by short-term volatility. Instead of worrying about whether the stock will go up or down tomorrow, you'll be focused on the company's ability to grow and create value over time. And when you take that long-term view, you'll find that your investments are more likely to succeed in the end. So, remember this. When it comes to investing, it's not just about the stock price. It's about the business behind the stock. Take the time to understand what you're investing in, and you'll be well on your way to making smart, long-term decisions that will serve you well. Let's take a moment to discuss something that trips up so many investors. Overconfidence? It's that all-too-human tendency to think you've got it all figured out, that you can outsmart the market, that you're somehow better than the average investor. But here's the reality. Overconfidence is one of the biggest mistakes you can make in investing. The truth is, even the best investors in the world are wrong sometimes, and you'll be wrong too, if you let your ego get in the way of your strategy. Overconfidence often shows up in a few ways. The most obvious is when people think they can beat the market. Maybe they've had a few successful investments, and now they feel invincible, like they've cracked the code. They start taking on more risk, believing that their past success means they can predict the future. This is where the trouble begins. The market doesn't care how successful you were last year. It's constantly shifting, and no one can accurately predict the future every time. Here's an important lesson. The market doesn't reward those who think they know everything. In fact, history is full of investors who were convinced they had figured it all out, only to watch their portfolios implode. Take, for example, the infamous story of long-term capital management, a hedge fund that was started by brilliant economists and traders in the 1990s. For a while, they were right about everything. They had a great track record, and they believed their sophisticated models could predict market movements with precision. But then, in 1998, the market threw them a curveball. They didn't see it coming, and their entire portfolio crashed, costing investors billions. Overconfidence and an inability to accept that they could be wrong led to their downfall. This isn't just about fancy hedge funds or financial institutions. Individual investors are just as susceptible. Maybe you've heard the story of someone who made a quick profit off a hot stock or a cryptocurrency, and now they believe they can do it again and again. They start making riskier investments, thinking their streak of success will continue indefinitely. But the reality is that the more confident you become, the more likely you are to ignore warning signs or take on risk that's simply unnecessary. There's another big problem with overconfidence. It often leads to poor decision-making. When you're convinced that you know exactly what's going to happen next, you're less likely to do the necessary research or listen to opposing viewpoints. You might think you've got a sure thing on your hands. But the truth is, no one can predict the market with certainty. And when you let your overconfidence guide your decisions, you're more likely to take on risk that you don't fully understand. Buffett, of course, is a great example of someone who avoids overconfidence. While many investors are busy trying to outsmart the market, Buffett focuses on sticking to his principles. He doesn't chase after trends or try to time the market. Instead, he focuses on finding good businesses, holding them for the long term, and letting the power of compounding do its work. He's humble enough to know that he doesn't have all the answers, and that's part of what makes him so successful. One way to avoid overconfidence is to keep track of your mistakes. Sounds simple, right? But many people refuse to acknowledge when they've been wrong. When things go wrong in the market, it's easy to blame external factors. The market was irrational, or I didn't see that news coming. But in reality, you probably missed some signals. The more you can learn from your mistakes, the better equipped you'll be to make smarter decisions moving forward. Another way to counter overconfidence is to always ask yourself the question, what could go wrong here? This is something that Buffett and other seasoned investors often do. They take the time to think about the risks involved in each investment, and they make sure they understand the worst-case scenario. This approach keeps them grounded and helps them avoid taking on too much risk. Let's take a look at a common example. Investors who get into speculative stocks or cryptocurrencies because they've seen others make a quick profit. The first mistake they make is overestimating the potential for those assets to keep rising. They forget that these types of investments are often volatile and that the market can shift suddenly. The second mistake is assuming that just because they've seen some success in the past, they're guaranteed success again in the future. But remember, past performance is no guarantee of future results. Every investment carries risk, and that's something you need to be prepared for. Another aspect of overconfidence is when investors ignore the importance of diversification. When you feel like you've got it all figured out, you might think you can put all your money into one stock or one sector. But the reality is, this is a huge gamble. No one can predict how any one company or asset class will perform in the future, so putting all your eggs in one basket is dangerous. Even Buffett, who's known for making concentrated bets on companies he believes in, diversifies across industries and investment types. It's part of a long-term strategy to reduce risk and ensure steady growth. The key takeaway here is this: never underestimate the power of humility in investing. Recognize that you don't have all the answers. Understand that you will make mistakes, and that's okay. The best investors, including Buffett, don't think they know everything. They know that there's always something to learn and that the market is unpredictable. Overconfidence can lead to poor decisions and big losses, but staying humble and recognizing your limitations can help you make smarter, more calculated investments. So, the next time you're feeling overly confident about a stock or investment, take a step back, reassess the situation. Ask yourself, what could go wrong here? Am I taking on too much risk? And most importantly, am I making this decision because I understand the business, or because I'm just chasing a trend? By staying grounded and realistic, you'll avoid the trap of overconfidence and set yourself up for long-term success. Let's shift gears a bit and talk about one of the most crucial concepts in investing that gets brushed under the rug too often: risk management. You might be thinking, well, investing always involves some risk, right? And you'd be absolutely right. But the question is, how much risk are you willing to take? And how do you protect yourself from the risks that could hurt your long-term success? Risk is a natural part of investing, but that doesn't mean you should approach the market with reckless abandon. It's essential to understand that not all risks are created equal, and some are avoidable, while others are simply part of the game. The key to being a successful investor isn't about avoiding risk altogether, because let's face it, you can't but about managing it in a way that doesn't derail your financial goals. Let's break down risk in a way that makes it easier to digest. When you think of risk, most people think of the potential for losing money. That's definitely a big part of it. But risk isn't just about losing your investment. It's also about the volatility, the ups and downs of the market, and how that affects your ability to stick to your investment plan. The market can be unpredictable, but how you react to that unpredictability is what separates successful investors from those who get wiped out during tough times. Consider this. During times of economic uncertainty or a market downturn, it's easy to panic and make rash decisions. You see the value of your portfolio drop, and suddenly, the fear sets in. You sell everything in a desperate attempt to avoid further losses. And just like that, you've locked in your losses. This is what we call panic selling. And it's one of the most common mistakes investors make when they don't have a solid risk management strategy in place. Buffett, on the other hand, takes a more measured approach. He's known for saying that the most important thing in investing is not how much money you make, but how little money you lose. In other words, the real key to success in investing isn't about chasing high returns. It's about protecting yourself from catastrophic losses. And the way you do that is by understanding your risk tolerance and positioning yourself accordingly. Your risk tolerance is essentially how much volatility you're comfortable with in your investments. Some investors can handle the emotional ups and downs of the market without breaking a sweat, while others may find it difficult to stomach the kind of market fluctuations that come with investing in stocks. It's important to know where you stand. If you're someone who panics at the sight of your portfolio losing value, then maybe a more conservative approach is in order. On the other hand, if you're okay with taking on more risk in exchange for the potential of higher returns, you might lean more toward aggressive investments. Here's a simple example. Let's say you're in your 20s or 30s, and you're just starting your investing journey. At this stage, you have time on your side, so you can afford to take on more risk in your portfolio. You might invest in stocks or growth-focused mutual funds with the potential for high returns over the long term. But, and this is a big but, if you're nearing retirement and you've built up a significant amount of wealth, you'll likely want to dial back that risk. You'll probably shift toward more stable, income-generating investments, like bonds or dividend-paying stocks, to preserve your wealth and avoid putting your nest egg in jeopardy. Now, let's talk about diversification again. Yes, it's that important. Diversification is one of the primary ways to manage risk. By spreading your investments across different asset classes, industries, and regions, you're helping to reduce the impact of any one investment's performance on your overall portfolio. This means that if one stock or asset class takes a dive, the rest of your portfolio may still hold steady. But, as we've discussed before, diversification isn't about throwing your money into everything and hoping for the best. It's about being strategic with your choices. A good diversified portfolio isn't just about quantity, it's about quality. Choose assets that complement each other and fit within your risk tolerance. For example, mixing growth stocks with value stocks or adding bonds alongside equities can help you create a more balanced portfolio that can weather market storms. Another key aspect of risk management is regularly rebalancing your portfolio. Over time, the performance of different investments in your portfolio will shift, and that can throw off your original asset allocation. For example, if you've been investing heavily in stocks, and the stock market has done particularly well, stocks might make up a larger portion of your portfolio than you originally intended. Rebalancing involves selling some of your winning assets and buying more of your underperforming ones to maintain the right balance. This helps ensure that you're not taking on more risk than you're comfortable with, and it keeps your portfolio aligned with your long-term goals. But here's the catch. Rebalancing isn't about constantly tinkering with your portfolio. The goal is to make adjustments only when necessary. If you're constantly buying and selling based on short-term movements in the market, you'll end up paying higher transaction fees, and you might even miss out on potential gains by making knee-jerk reactions. One of the best ways to manage risk is by being patient. It's easy to get caught up in the short-term fluctuations of the market, but the most successful investors know that it's the long-term growth that matters most. Instead of reacting to every bump in the road, focus on your long-term goals and let your investments ride out the volatility. That's where the magic of compounding kicks in, and where you'll really see the fruits of your disciplined strategy. But let's not sugarcoat this. Risk is a real part of investing. The goal isn't to eliminate risk entirely, because that's impossible. It's about understanding and managing that risk so that you can make smart, informed decisions that align with your goals. And if you manage your risk effectively, you'll be able to sleep soundly, knowing that your portfolio is working for you even when the market isn't. Risk management is the foundation of a successful investing strategy. And if you can balance your risk tolerance, diversify wisely, and stay disciplined, you'll be much better positioned to ride out market storms and come out ahead in the long run. Now that we've covered risk management, let's dive into another essential aspect of successful investing: focusing on what you know. One of the biggest mistakes investors make is stepping outside their circle of competence, trying to jump into sectors or industries they don't fully understand. And while it may sound tempting to chase the next big thing or follow the crowd into a hot industry, the truth is, sticking to what you know is one of the best ways to succeed. Warren Buffett has always preached the importance of sticking to your circle of competence. What does that mean? Essentially, it means investing in industries or companies that you understand well. If you don't fully comprehend the product, service, or market dynamics, then you're operating with a significant disadvantage. Even if a stock is hot or making headlines, if you don't understand how the company makes money or what drives its success, you're taking on unnecessary risk. You might get lucky, but over time, the odds will catch up with you. The principle behind focusing on what you know is simple. If you understand a company's business model, its strengths and weaknesses, and the market it operates in, you'll be in a better position to make informed decisions. This means you won't be swayed by hype or external noise. You'll be able to evaluate the company based on its fundamentals, not its popularity. Take Buffett's investment in Coca-Cola as an example. He didn't buy Coca-Cola because it was a trendy stock or because it was in the media spotlight. He bought Coca-Cola because he understood the company's business, its brand strength, its global reach, and its ability to generate consistent cash flow. And over time, that investment has paid off handsomely. Coca-Cola isn't flashy, but it's been a stable, reliable company for decades, and Buffett understood that from the very beginning. The same principle applies to any industry. If you're passionate about technology and have a deep understanding of how the tech sector works, then it makes sense to focus on tech stocks. If you're interested in healthcare and know the ins and outs of the industry, then it might be a good idea to invest in healthcare companies. The key is not to jump into unfamiliar sectors just because they're getting attention. Instead, stick to industries you know well and focus on companies with solid fundamentals within those industries. Let's look at a common mistake people make when they venture outside their circle of competence, jumping into emerging markets or speculative industries without fully understanding them. A few years ago, cryptocurrency was all the rage. Everyone was talking about Bitcoin, Ethereum, and all the other altcoins. It seemed like a gold rush, and many investors dove in, hoping to make quick gains. But here's the problem. Cryptocurrencies are complex and highly volatile. If you don't understand the technology behind them, the regulatory landscape, or the potential risks, you're essentially gambling. For some, this gamble paid off in the short term, but for many others, it led to significant losses. This is where focusing on what you know comes into play. If you don't understand the intricacies of cryptocurrency or blockchain technology, then it's wise to stay on the sidelines until you do. You don't need to jump on every trend that comes your way. The best investors are the ones who focus on their areas of expertise, and they don't feel the need to chase after every new shiny object in the market. Now, let's take this back to the basics. If you're new to investing, start by focusing on industries or companies that you already have some knowledge about. Maybe you've worked in retail and have a good understanding of how consumer behavior affects companies in that space. Or perhaps you have a background in technology, and you're familiar with how the industry is evolving. Whatever your area of expertise is, that's where you should begin your investment journey. As you gain more experience, you can expand your circle of competence, but always make sure you're staying within a space where you can make informed decisions. One way to build up your knowledge is to read extensively about the industries you're interested in. Understand the trends, the key players, and the challenges that companies in those industries face. Learn about the financials, the competitive landscape, and the regulatory environment. The more you understand, the more confident you'll feel in your decisions, and the better your chances of success will be. Another important piece of this is avoiding the temptation to follow the crowd. It's easy to get caught up in the hype of a hot stock or the latest investment trend. You see people on social media talking about their latest gains, and suddenly, you feel the urge to join in. But remember, just because something is popular doesn't mean it's a good investment. Focus on your own understanding and don't let the opinions of others influence you too much. The best investors have always been the ones who are able to block out the noise and stick to their strategy. In fact, Buffett has famously said, "The stock market is a device for transferring money from the impatient to the patient." If you want to be a successful investor, you need to take a long-term view. This means not getting caught up in the short-term fluctuations of the market or following the herd. Instead, focus on companies and industries that you understand and believe will create long-term value. Let's talk about some of the key benefits of sticking to what you know. First, it allows you to make more informed decisions. When you understand the business, you can evaluate whether its stock price is too high or too low, based on its fundamentals. You'll have a better sense of whether the company is undervalued or overvalued, which will help you make better investment decisions. Second, it reduces the likelihood of emotional investing. When you're invested in something you understand, you're less likely to panic when the market fluctuates. You'll have confidence in the company's long-term prospects and be able to ride out the volatility. Finally, sticking to what you know allows you to take advantage of opportunities that others may overlook. Because you have a deeper understanding of the industry, you can spot trends or companies that others might miss. This gives you an edge in making smart investment decisions. So, remember, focus on what you know and invest in industries and companies you understand. Don't get caught up in the hype or try to chase every trend. Stick to your circle of competence, and you'll be on the path to long-term success. All right, now that we've talked about the importance of sticking to what you know, let's turn our attention to a topic that can make or break your investment journey: managing your expectations and staying realistic. It's easy to get caught up in the dream of making huge returns overnight, especially when you see other people posting their gains on social media or hear about the next big stock that's going to the moon. But here's the truth. Real investing is about managing expectations and understanding that steady, long-term growth is what really leads to success. Investing isn't a sprint, and it's not a get-rich-quick scheme. So many people come into the market with unrealistic expectations, expecting to double their money in a matter of months, or thinking that they'll consistently beat the market. The reality is that even the best investors in the world don't always have the same returns year after year. Sometimes, the market goes through periods of stagnation or downturns. But if you can manage your expectations, stay disciplined, and keep your focus on the long term, you'll have a much better chance of building sustainable wealth. When it comes to setting realistic expectations, one of the most common mistakes is expecting too much. Too soon, people hear about massive returns from tech stocks or cryptocurrencies, and they think it's easy to replicate that success. But remember, those kinds of returns aren't the norm. In fact, the average long-term return of the stock market is about 7% annually. After inflation, that's not flashy, but it's a reliable and steady way to build wealth over time. This brings us to a concept that Buffett often refers to: the importance of long-term thinking. When you invest, you should expect to hold your investments for years, not days or months. Think about it. The stock market goes through cycles. There are periods of rapid growth, followed by periods of correction or stagnation. But over the long run, the market tends to move upward. That's why patience is such a key part of investing. The longer you can hold on to your investments, the better your chances of seeing your wealth grow. The problem with unrealistic expectations is that they often lead to poor decision-making. When you're expecting huge returns in a short period of time, you're more likely to take on excessive risk in an attempt to hit it big. Maybe you'll jump into speculative stocks or cryptocurrencies, hoping to replicate those early morning gains you saw someone else post online. Or you might try to time the market, thinking you can sell before the next downturn or buy just before the next rally. But that's a dangerous game. The market is unpredictable, and no one can time it perfectly every time. Here's a lesson you can learn from Buffett's approach. He doesn't chase after the next hot stock or attempt to predict short-term movements. Instead, he invests in businesses he believes will continue to grow over the long term. He's realistic about the returns he expects and isn't swayed by short-term market fluctuations. For Buffett, investing is about finding companies that have a durable competitive advantage and holding on to them for years, allowing them to compound and grow. And guess what? That's worked out pretty well for him. But even Buffett isn't immune to market downturns. Every investor has to deal with market volatility. The difference is that the most successful investors don't let these fluctuations dictate their decisions. They don't sell when the market drops or panic during times of uncertainty. Instead, they stay calm, stick to their long-term strategy, and let the market do its thing. It's also important to recognize that investment success isn't always about hitting home runs. In fact, it's often about avoiding massive losses and having steady, consistent growth over time. A big win here and there might make the headlines, but the real wealth is built through consistency, patience, and a well-thought-out strategy. By keeping your expectations grounded, you're more likely to avoid the emotional roller coaster of chasing big returns and make more rational, thoughtful decisions. Managing your expectations also involves understanding the role that risk plays in your investments. When you're younger, you might be willing to take on more risk because you have time to recover from any losses. But as you get older and your time horizon shortens, you might want to adjust your risk tolerance. You should always have a clear idea of how much risk you're comfortable taking on based on your goals, time frame, and personal circumstances. And just because you can take on more risk doesn't mean you should. The goal is to find a balance that aligns with your objectives and allows you to sleep soundly at night. Another key part of managing expectations is recognizing that market downturns are normal. Everyone gets excited when the market is up, and no one likes it when the market drops. But it's during those downtimes that your strategy really gets tested. If you're invested in high-quality businesses, you can view a market downturn as an opportunity to buy more of those businesses at a discount. But if you're focused on short-term gains or speculative investments, you might be tempted to panic and sell. It's at this point where managing your emotions becomes crucial. By sticking to your strategy and staying calm, you'll be able to ride out the volatility and emerge stronger in the long run. Another area where unrealistic expectations often come into play is in the search for the perfect investment. People look for the one stock that's going to make them rich, the one investment that's going to change their financial future. But the truth is, there's no such thing as a perfect investment. Every investment carries some degree of risk, and you're not going to hit a home run every time. Instead, focus on building a portfolio of high-quality, well-researched investments that have the potential for long-term growth. If you aim for steady, consistent returns over time, you'll be much more successful than if you're chasing after the next big thing. Let's also remember that successful investing is not about beating everyone else. You don't have to be the best investor in the world to be successful. In fact, trying to compete with others can lead to bad decisions. Instead, focus on your own strategy, stick to your plan, and let the results speak for themselves. The most successful investors are those who understand the reality of investing and manage their expectations accordingly. It's not about chasing big, fast gains. It's about staying patient, managing risk, and focusing on long-term growth. By staying realistic and avoiding the temptation to make quick decisions based on short-term fluctuations, you'll be well on your way to achieving your investment goals. Now that we've discussed managing expectations, let's take a step back and look at a concept that often gets overlooked by many investors: the hidden costs of investing. When you think about making an investment, your first thought is likely about how much you stand to gain. But what about the costs that can chip away at your returns over time? Taxes, fees, and commissions. These can quietly eat away at your profits, and too often, investors ignore them until it's too late. Let's start with taxes. We all know taxes are a part of life. But when it comes to investing, they can have a major impact on your returns. Depending on the type of investment account you have, the gains you make from your investments can be taxed in different ways. For example, in taxable brokerage accounts, any profits you make from selling investments are subject to capital gains taxes. If you've held an investment for more than a year, you're eligible for long-term capital gains rates, which are typically lower than short-term rates. But here's the catch. If you're constantly buying and selling investments, you might end up triggering short-term capital gains taxes, which can be much higher. And taxes don't just apply when you sell investments. Let's say you're earning dividends from a stock or mutual fund. Depending on the type of dividends you're receiving, qualified or non-qualified, you could be paying a higher tax rate on those as well. This is why it's crucial to be mindful of the tax implications of your investments. A little tax planning can go a long way in maximizing your returns. One way to reduce the impact of taxes is by utilizing tax-advantaged accounts, like an IRA or 401k. These accounts allow your investments to grow tax-deferred or even tax-free, depending on the type of account. By taking advantage of these accounts, you can avoid paying taxes on your gains until you withdraw the money. And in some cases, you can even avoid paying taxes altogether. But taxes aren't the only hidden cost you need to worry about. Fees and commissions can also take a significant bite out of your investment returns. If you're buying and selling stocks through a brokerage, you may be paying commission fees. These fees may seem small at first, but over time, they can add up, especially if you're making frequent trades. Let's say you're paying a $10 commission on each trade, and you make 100 trades in a year. That's $1 in fees. Now, if your portfolio only grew by $2 more that year, then 50% of your gains went straight to commissions. That's a pretty big chunk of your profits. And it's something you'll want to keep in mind when deciding on an investment strategy. Another fee to be aware of is the expense ratio on mutual funds and exchange-traded funds ETFs. The expense ratio is the annual fee that fund managers charge for managing the fund. This fee is taken out of the fund's assets, which means it reduces your returns. Even though the expense ratio is usually a small percentage, it can add up over time. For example, If you have a $100 0 investment in a fund with an expense ratio of 1%, you're paying $1 a year in fees, whether or not the fund performs well. The higher the expense ratio, the more it eats into your returns. This is why it's important to compare the fees of different funds before making a decision. Let's not forget about the costs associated with actively managed funds. These funds have fund managers who make decisions about which stocks to buy and sell. While this might sound like a good thing, it comes with its own set of costs. Actively managed funds tend to have higher fees compared to index funds, which are passively managed. If the fund manager isn't outperforming the market, then you're paying higher fees for no better performance. In fact, studies have shown that over time, most actively managed funds underperform their benchmark indexes. That's why many successful investors, like Warren Buffett, advocate for low-cost index funds as a better alternative. But here's the twist. Even if you're in a low-cost index fund, there can still be other hidden costs. For example, if the fund holds a large number of stocks, some of which are volatile or not aligned with your investment strategy, you could be exposed to unnecessary risk. It's not just about the fees, it's also about making sure the fund aligns with your goals and risk tolerance. Now, let's talk about something that might seem a little abstract, but is incredibly important. The opportunity cost of your investments. Opportunity cost refers to what you're giving up by making one investment over another. When you decide to invest in a certain stock or fund, you're also choosing not to invest in something else that could have offered better returns. This is something that investors often overlook, but it's a key part of making smart investment decisions. For example, let's say you're deciding between two stocks. One has a solid track record and steady growth, but the other is more speculative, with the potential for huge returns but also massive risk. If you choose to invest in the riskier stock, you're giving up the steady, reliable growth of the first stock. Even if the riskier stock does well in the short term, it might not provide consistent returns over the long term. So, the opportunity cost of choosing that stock is the potential steady growth you could have had by going with the safer option. To avoid getting caught up in opportunity cost, it's important to always assess your options carefully. Look at the potential returns, but also consider the risks and how the investment aligns with your overall strategy. Keep in mind that just because something is popular or has big upside potential doesn't mean it's the right investment for you. The goal is to make decisions that align with your long-term goals, risk tolerance, and values. And finally, there's the emotional cost of investing. This is the part that no one really talks about, but it's something that affects everyone. When the market takes a dip, or when one of your investments underperforms, it can be stressful. The emotional strain of watching your portfolio fluctuate can cause you to make irrational decisions, like selling in a panic or chasing the next big thing. The emotional toll of investing can't be ignored, and it's something that every investor needs to manage. By staying disciplined, focusing on your long-term goals, and not reacting to short-term fluctuations, you can reduce the emotional cost of investing. In conclusion, when you're making investment decisions, it's not just about the potential gains. Be aware of the hidden costs: taxes, fees, commissions, opportunity costs, and the emotional toll. By accounting for these costs, you'll be in a better position to make smarter, more informed decisions, and ultimately, maximize your returns over time. At this point, we've covered many of the crucial elements of investing. But there's one last key area we need to focus on: sticking to your strategy during difficult times. Whether the market is experiencing a downturn or you're dealing with personal challenges, staying the course is often the hardest thing to do, but it's also one of the most important. You see, the market doesn't always go up. In fact, there will be times when the market drops, sometimes dramatically. You'll watch your portfolio's value fluctuate, and the media will be buzzing with talk of the latest crisis. It's in these moments that your resolve will be tested. The temptation to make emotional decisions like selling everything to avoid further losses will be strong. But here's the truth. This is exactly when sticking to your strategy is most critical. Warren Buffett has always said that the best time to buy stocks is when others are fearful. When the market is down, that's often when the best opportunities arise. But most investors get scared when they see their portfolios shrink. They start to panic, sell off their assets, and miss the chance to buy valuable investments at a discount. That's the emotional trap that most investors fall into. Let's take a moment to reflect on the 2008 financial crisis. In the midst of the market's collapse, panic selling was at an all-time high. People were losing their homes, their jobs, and their investments. The stock market seemed like a scary place to be. But those who stuck to their long-term investment strategies and continued to invest, rather than panic, ended up reaping significant rewards. The market recovered, and those who stayed the course saw their investments grow over time. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." What he's getting at is the importance of buying when the market is undervalued and holding steady when things seem uncertain. It's not about trying to time the market or make quick profits. It's about having the patience to wait for your investments to recover and grow. And over time, they almost always do. But here's where most investors go wrong. They get emotional. Instead of staying the course, they allow fear to take over. They sell off investments at the worst possible time, locking in their losses, and then they're left watching the market recover without them. This kind of emotional reaction to market fluctuations is one of the biggest barriers to long-term success in investing. Another factor that contributes to people veering off course is the constant barrage of news and market opinions. Every day, there's a new headline or analysis about the latest market trend, and it's easy to get swept up in the hysteria. But the truth is, most of this news doesn't matter in the long run. Short-term fluctuations in the market are just that short-term. If you're investing for the long term, those daily ups and downs shouldn't affect your strategy. This is why it's so important to have a solid strategy in place, one that you believe in and can stick with during tough times. Your strategy should be based on sound principles, like investing in companies with strong fundamentals, staying diversified, and focusing on long-term growth. When you have a clear plan, you won't be as likely to make emotional decisions based on short-term market movements. It's also crucial to avoid making knee-jerk reactions based on fear of missing out FOMO. In bull markets, it's tempting to jump into every stock that's showing gains, thinking you'll get rich quick. But when you're driven by fear of missing out, you're often not making rational decisions. You're buying into stocks that might be overvalued, and you're chasing returns rather than focusing on solid, long-term investments. This emotional roller coaster can cause you to make decisions that go against your strategy, and it can hurt your long-term returns. But it's not just about market downturns. Staying the course also means not getting overly excited when the market is on an upswing. When your investments are performing well, it's easy to get complacent or to start thinking that you've cracked the code. This is another point where sticking to your strategy is key. It's tempting to think you can outsmart the market. But remember, the market doesn't care how successful you've been in the past. Staying disciplined and following your strategy, even when things are going well, is just as important as staying disciplined when things aren't. One thing that can help you stay on track during difficult times is to remind yourself of your long-term goals. Investing isn't about short-term gains. It's about building wealth over time. So, when the market dips or your portfolio drops in value, ask yourself, does this change my long-term outlook for this investment? If the answer is no, then stay the course. Don't make emotional decisions based on short-term fluctuations. Another tactic that helps during rough times is dollar cost averaging. This is the practice of consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you're buying more shares when the market is down and fewer shares when it's up, which helps smooth out the volatility. Dollar cost averaging forces you to stick to your plan and avoid the temptation to try to time the market. And over the long term, this strategy can significantly reduce the impact of market swings on your portfolio. Now, I get it when you see your investments go down in value. It's hard not to feel anxious. It's only natural to want to protect your money. But keep in mind that investing is a long-term game. As long as you've done your research and invested in quality companies, your portfolio will likely recover and grow over time. Just remember, market downturns are temporary. The key is to stay disciplined and keep your focus on the long term. So, what's the takeaway here? It's simple. Stay patient and stick to your strategy. Even when things get tough, the market will go up and the market will go down. But if you're investing for the long term, those short-term fluctuations shouldn't shake your confidence. Stay the course. Keep your emotions in check. And remember that investing is a journey, not a sprint. We've covered a lot of ground over the past sections, from managing expectations to understanding the hidden costs of investing, and from focusing on long-term growth to sticking to your strategy during tough times. But now it's time to bring everything together and talk about what truly makes an investor successful in the long run. Consistency and discipline. At the core of every successful investing strategy is the ability to stay consistent and disciplined. No matter what the market is doing, it's easy to get distracted by short-term volatility or the latest hot stock. But the real wealth is built over time by following a consistent, well-thought-out strategy. Discipline in investing means staying true to your plan, even when the market is moving in a direction that you didn't expect. Whether the market is going up, down, or sideways, successful investors know that sticking to their strategy is the key to long-term success. They don't get caught up in the emotions of the moment, and they don't make impulsive decisions based on what's happening in the market today. They stay calm, stick to their approach, and trust the process. Let's take a step back for a moment. What does being disciplined in investing actually look like? Well, it means that you have a clear, written strategy for your investments and that you follow it to the letter. It means that you aren't swayed by market hype, news stories, or the latest trends. You know your goals, you understand the risks, and you're focused on achieving consistent, long-term growth. One of the best ways to maintain discipline is by automating your investments. Setting up automatic contributions to your investment accounts can help ensure that you're investing regularly, no matter what's going on in the market. This takes the emotion out of the process and allows you to stay on track, even when the market is volatile. Consistent investing, whether it's through regular contributions to a 401k, an IRA, or other investment accounts, helps you build wealth over time without being distracted by short-term market movements. But it's not just about consistency in terms of how often you invest, it's about staying consistent in your approach. This means that even when the market is soaring, you don't let greed tempt you into making risky moves. And when the market is down, you don't panic and sell off your investments out of fear. Instead, you stick to your plan and trust that your long-term strategy will pay off. Take the example of Warren Buffett's investment philosophy. He's been investing for decades, and over that time, he's seen market booms and crashes, political upheavals, and economic recessions. But through it all, Buffett has remained consistent in his approach. He buys businesses he believes in, holds them for the long term, and doesn't worry about short-term market fluctuations. His focus has always been on building wealth over time, and it's this discipline that has allowed him to become one of the wealthiest people in the world. The reason Buffett's strategy works is because it's grounded in consistency and long-term thinking. While others are chasing quick gains or trying to time the market, Buffett is buying great companies and holding them for decades. He's not trying to get rich overnight. He's building wealth steadily and consistently, which is ultimately what leads to success in investing. Of course, this approach isn't without challenges. Staying disciplined requires a great deal of patience and self-control. In a world where instant gratification is the norm, it's difficult to stick to a long-term strategy that doesn't promise immediate rewards. But if you want to achieve lasting success, you need to embrace the idea that investing is a marathon, not a sprint. The market will go up and down, and there will be times when you feel like your investments aren't paying off. But if you stick to your plan, continue investing regularly, and remain patient, you'll be in a much stronger position when the market inevitably rebounds. Another important element of discipline is avoiding the temptation to overcomplicate things. It's easy to get caught up in trying to find the next big thing or trying to make the perfect investment. But the truth is, the most successful investors are often the ones who keep things simple. They stick to a basic strategy, focus on companies with solid fundamentals, and avoid jumping from one investment to the next. The more complex your strategy, the more likely it is that you'll get distracted or make mistakes. Keep it simple, stay focused, and let your investments work for you over time. This leads us to the final point, the importance of reviewing your investments regularly but not obsessing over them. It's important to assess your portfolio from time to time to make sure it aligns with your goals and risk tolerance. But checking your investments every day or reacting to every little market movement is a surefire way to derail your discipline. Instead, focus on the long term and review your investments periodically, quarterly, or annually, and make adjustments if necessary. But don't let the daily fluctuations distract you from your larger goal. Staying disciplined also means being willing to adjust when circumstances change. If you have a major life event like a job change, marriage, or retirement, it may be time to reassess your portfolio. But even in times of change, discipline is about sticking to your strategy and making thoughtful adjustments rather than reacting impulsively to emotions or short-term events. The final takeaway here is that consistency and discipline are the two most important factors in long-term investing success. The road to wealth isn't glamorous or exciting. It's about sticking to a strategy, staying patient, and letting time do the heavy lifting. If you can stay disciplined, avoid the emotional roller coaster, and focus on steady growth, you'll set yourself up for success. Investing is a journey, not a race. It's about consistent, deliberate action over time. So, embrace the discipline that's required to stick to your strategy, and you'll find that the market will reward you in the end.